Imagine navigating a storm-tossed sea. Some ships surge forward, propelled by roaring engines only to founder when fuel runs out. Others, steady vessels with deep ballast, weather the waves with composure and arrive safely. Today, we explore why dividend-paying companies are the deep, ballast ships that survive and even thrive when debt storms rage. When you study how companies survive and succeed through the inevitable swings of the economic machine, you start to notice a pattern. The ones that last aren't the flashiest or the most aggressive during good times. They're the ones with the most reliable cash flows. Reliable cash flow isn't just a number on a balance sheet. It's the oxygen of a business. Without it, even the most innovative product or the most ambitious growth plan collapses when the environment changes. And in periods when debt cycles turn against you, when interest rates rise, credit tightens, and capital is no longer cheap, cash flow is the difference between staying afloat and sinking. A company that generates consistent cash from operations is insulated from the dependency on external financing. When borrowing costs shoot up, many firms scramble to refinance, roll over debt, or raise capital on unfavorable terms. That scramble can destroy equity value quickly, but if a company can meet its needs from what it earns, it is far less vulnerable to the whims of lenders or the mood of the market. This self-sufficiency allows it to operate from a position of strength when others are negotiating from weakness. It also means that management can focus on making strategic decisions, whether that's reinvesting, paying down debt, or returning capital to shareholders, instead of fighting for survival. Cash flow resilience isn't an accident. It's the product of business models that are built to generate value steadily across different phases of the cycle. Think about companies in industries with recurring demand, pricing power, and cost discipline. These are the kinds of businesses that don't need the economy to be booming to keep their revenue streams healthy. Even in slowdowns, their customers still buy, their margins hold, and their operations don't require excessive working capital injections. That reliability compounds over time because steady cash flow allows a company to plan long-term, avoid panic decisions, and take advantage of opportunities when competitors are distressed. It's also important to see cash flow resilience as a buffer against leverage risk. Debt itself isn't inherently bad. It can be a useful tool when managed prudently. But in a tightening cycle, the companies that survive are those whose operating cash comfortably covers their interest obligations and essential investments. These companies can not only maintain their debt service without cutting into muscle, but also negotiate better terms when they choose to borrow. Lenders and investors are more willing to extend favorable credit to firms that have demonstrated they can produce cash consistently, regardless of the external environment. From an investor's perspective, resilient cash flow is an early warning system and a safety net rolled into one. If you track a company over years and see that its cash generation remains stable or even grows during periods when others are faltering, you're looking at a business with built-in shock absorbers. That kind of stability often shows up in steady dividend payouts, which further signal management's confidence and the company's ability to generate distributable earnings without starving its growth. This is why dividend-paying companies so often overlap with companies that have resilient cash flows. They're simply the ones that can afford to commit to those payouts without risking operational health. Ultimately, in the broader context of debt cycles, resilient cash flow acts like ballast in a ship. It doesn't make the storms go away, but it prevents the vessel from capsizing when the winds shift and the waves hit. The companies with this kind of financial ballast can ride out the rough periods, use the downturns to strengthen their competitive position, and emerge on the other side ready to grow again. And over decades of observing these cycles, the conclusion is clear. The businesses that control their cash flow, rather than letting the credit cycle control them, are the ones that endure and compound value the longest. In markets, perception and reality are deeply intertwined, and nowhere is that more visible than in how companies handle their dividend policies during uncertain times. A sustained or growing dividend is more than a financial transaction. It's a powerful signal. It communicates to investors, creditors, and even competitors that the business not only has the resources to maintain its commitments, but also has a clear line of sight into its future earnings. In periods when debt cycles tighten and credit becomes scarce, that kind of signal can be the difference between attracting capital and watching it flow elsewhere. When a company declares and maintains its dividend through turbulent conditions, it's effectively saying, "We have the confidence and the capacity to keep rewarding our shareholders without jeopardizing our long-term health." That statement is not made lightly. Dividends are cash outflows that can't be faked. They must come from actual available earnings or cash reserves. This is why the market takes them seriously, because it's one thing to talk about strong fundamentals and another to put real cash in shareholders' hands quarter after quarter. This signaling effect goes beyond shareholders. Lenders, suppliers, and strategic partners all interpret a stable or rising dividend as a mark of operational and financial discipline. It suggests the company's cash flows are not only sufficient to cover operating needs and debt obligations, but also strong enough to return capital while still reinvesting for growth. In other words, it points to a balance sheet and income stream that can handle stress. That perception often becomes self-reinforcing. The more confidence stakeholders have in a company's stability, the more likely they are to extend favorable terms, offer credit, or agree to long-term agreements, all of which strengthen the company's resilience in a tightening debt environment. The flip side is also telling. A dividend cut or suspension often sends a shock through the market, not only because of the lost income to investors, but because it's interpreted as an admission that the business is under stress. Sometimes this is unavoidable and part of prudent management, but the reputational impact can be lasting. Markets have long memories, and credibility once lost is hard to rebuild. That's why companies with a long track record of consistent or growing dividends are in a special category. Their history builds a kind of trust equity, a belief that management is both committed to shareholder returns and capable of delivering them, regardless of macroeconomic headwinds. In debt-heavy cycles, this trust becomes an invaluable strategic asset. Investors looking for safety gravitate toward firms with proven dividend stability, creating a natural demand for their shares. This can help support the stock price and reduce volatility, which in turn can lower the company's cost of capital. It's a feedback loop. Stability attracts capital, which makes it easier to remain stable. But signaling strength through dividends is not about bravado. Recklessly maintaining a pay-out by borrowing heavily or underinvesting in the business will eventually erode the very foundation that supports the dividend. The signal only works if it's backed by genuine strength, consistent earnings, prudent balance sheet management, and disciplined capital allocation. That's why the most respected dividend paying companies tend to be conservative with leverage, transparent in communication, and deliberate in how they set payout ratios. In the end, signaling strength through dividends is less about impressing the market in the short term and more about establishing a reputation for reliability over decades. In the ebb and flow of debt cycles, that reputation becomes a moat. Stakeholders, whether they're equity investors, bondholders, or partners, see the dividend not as a perk, but as evidence of a business that has mastered the art of balancing reward and resilience. In a world where trust can evaporate overnight, that's a rare and durable advantage. When you look closely at the companies that survive the harshest phases of a debt cycle, you notice that they often belong to industries where demand doesn't swing wildly with the economic climate. These are the defensive sectors, businesses built around products and services people need regardless whether credit is cheap or expensive, growth is booming or contracting. Utilities keep the lights on. Healthcare providers supply essential treatments and medicines. Consumer staples put food and household goods on shelves. These aren't optional expenditures in most people's lives, they're necessities. That fundamental demand stability is what gives these sectors their defensive character, and in debt-heavy environments, that stability becomes a shield. When debt cycles tighten, interest rates rise, and economic growth slows, highly cyclical sectors, like luxury goods, high-end technology, or speculative real estate, often feel the strain first. Their revenue streams are more dependent on discretionary spending and easy credit, both of which dry up when financial conditions harden. Defensive sectors, on the other hand, tend to be insulated from these shocks because their customers can't simply walk away from the products or services they provide. Electricity bills get paid before vacations are booked. Prescription refills happen whether GDP is expanding or contracting. Groceries are bought even when consumer confidence dips. This stability in demand translates into more predictable cash flows, which are the lifeblood of dividend payments. Companies in defensive sectors often maintain or even grow dividends during downturns because their revenues are less volatile. This is why many dividend-focused portfolios are overweight in these areas. They're the ballast that steadies the portfolio when markets are in turmoil. And the steadier the revenue, the easier it is for a company to manage debt obligations without resorting to distressed measures like asset sales, deep cost cuts, or dividend suspensions. Another reason defensive sectors thrive in debt cycles is that they tend to have established, regulated, or monopolistic market positions. Utilities, for example, often operate under regulated frameworks that allow them to pass certain costs on to consumers, preserving margins even when expenses rise. Large healthcare providers benefit from long-term contracts with insurers or government programs, creating predictable revenue streams. Consumer staples companies frequently control powerful brands with pricing power, enabling them to maintain profitability even when input costs rise. These structural advantages mean that when the economic tide goes out, they're still standing on solid ground. The market rewards that resilience with capital inflows during periods of uncertainty. As investors reallocate from riskier assets to safety, defensive sectors often see relative outperformance. This inflow can support share prices and reduce volatility, further reinforcing their attractiveness to both equity and credit markets. In some cases, defensive companies even find themselves in a position to make strategic acquisitions during downturns, buying distressed competitors at favorable valuations, a luxury that more cyclical companies can rarely afford in tight credit conditions. But there's another subtle advantage. The culture of these industries often emphasizes operational consistency over aggressive expansion. In a rising rate environment, that restraint pays off. Rather than chasing high-risk growth funded by cheap debt, defensive sector management teams tend to focus on maintaining service quality, controlling costs, and optimizing capital structures. This conservatism means they're less exposed to refinancing risks and better prepared to manage through prolonged credit tightness. In the long arc of the debt cycle, these qualities, steady demand, predictable cash flows, structural advantages, and disciplined management combine to create a form of resilience that is rare in more cyclical parts of the economy. It's not that defensive sectors are completely immune to downturns, no business is. But when credit is scarce and the economy slows, these companies face headwinds that are manageable rather than existential. That's why, decade after decade, they emerge from each cycle not only intact but often stronger, having solidified their market positions while others were forced to retreat. In a world where leverage magnifies both gains and losses, being in the right sector can be as important as having the right strategy. Defensive positioning isn't just a portfolio decision, it's a survival mechanism. Dividend growth is more than just an attractive statistic to put in an investor presentation. It's a real measure of a company's ability to generate and compound value over time. When a business not only maintains but consistently raises its dividend, it's showing that its earnings power is not only stable but expanding. That expansion becomes a critical advantage in the harsher phases of a debt cycle, when capital is scarce, borrowing costs are high, and investor sentiment is cautious. In that environment, a growing dividend doesn't just provide income, it acts as a financial and psychological buffer for both the company and its stakeholders. From the company's perspective, committing to dividend growth forces discipline. Management can't promise higher pay outs year after year unless the underlying business is producing growing, sustainable cash flows. This means capital allocation decisions are made with a long-term lens. Projects that don't meet return thresholds get filtered out. Excessive leverage is avoided because it can jeopardize the ability to keep raising payouts. This kind of disciplined approach often leaves these companies better prepared for downturns. When debt cycles turn, they're not scrambling to cover interest expenses or refinance under unfavorable conditions. They have room to maneuver. From the investor's standpoint, dividend growth provides something rare in volatile markets, predictability. Even when share prices fluctuate due to macroeconomic concerns, a steadily rising stream of dividends offers a tangible, growing return. This can reduce the temptation for investors to sell in panic during market downturns, creating a more stable shareholder base. That stability, in turn, benefits the company by keeping its equity capital from being unduly pressured, which can be particularly valuable in times when debt financing is less accessible or more expensive. There's also a compounding effect that works quietly in the background. Reinvested dividends, especially those that are growing, can significantly boost total returns over long periods. This is one of the reasons why dividend growth stocks have historically outperformed in various market conditions. In debt-constrained environments where equity appreciation may be harder to come by, the reinvestment of an ever-increasing dividend can make the difference between a mediocre and a strong long-term investment outcome. The signaling power of dividend growth shouldn't be underestimated either. While maintaining a dividend suggests stability, raising it signals progress. It tells the market that not only can the company handle current conditions, but it expects to do even better in the future. This confidence can attract capital from both income-focused investors and those seeking stability in uncertain times. It also differentiates the company from peers who may be forced to freeze or cut their payouts under the same conditions. But the buffer effect isn't just about perception. Dividend growth creates a margin of safety in real economic terms. In a tightening credit cycle, the cost of capital rises, and companies without strong internal cash generation have to rely on more expensive or less available financing. A firm with a history of dividend growth is, by definition, a firm that's been generating more cash than it needs for operations and prudent reinvestment. That surplus gives it the flexibility to weather periods of reduced revenue or higher costs without cutting shareholder distributions or jeopardizing its long-term strategy. Over decades of observing market cycles, it becomes clear that dividend growth is not just an outcome of success, it's a driver of resilience. It disciplines management, builds investor trust, attracts capital, and compounds wealth. In the ebb and flow of debt cycles, where access to external funding can be fickle, that growing stream of internally generated cash becomes an anchor. It cushions the business against the shocks that sink more fragile competitors, and it ensures that both the company and its shareholders continue to move forward, even when the broader economic current is pulling others back. In any credit cycle, the companies that come out stronger are rarely the ones that took the most aggressive bets when money was cheap. They're the ones that understood the cost of leverage in both directions and kept it under control. Balanced capital discipline isn't about avoiding debt altogether, it's about using it with precision. Knowing that in a tightening cycle, every dollar borrowed carries more weight. When interest rates rise and credit becomes harder to access, leverage that once looked manageable can quickly turn into a burden that consumes cash flow, limits flexibility, and forces desperate decisions. The companies that thrive are those that structure their capital in a way that supports, not strains, their operations through every phase of the cycle. Dividends play an important role here because a sustainable payout policy naturally limits excess leverage. A firm committed to returning capital to shareholders must ensure it has the earnings and cash to do so without compromising reinvestment in the business. That kind of commitment tends to keep debt at levels that can be serviced comfortably, even when revenue slows or borrowing costs rise. It acts like a built-in governor, preventing management from overextending during boom times in ways that would be painful to unwind later. The danger in abandoning discipline is that debt can disguise underlying weakness during expansion phases. A company can borrow to fund growth, acquisitions, or even shareholder returns, creating the illusion of strength. But when the cycle turns, those obligations don't shrink just because revenues do. In fact, refinancing becomes more expensive, lenders grow more cautious, and capital markets may not be willing to provide the same terms, or any terms at all. This is when the difference between disciplined and reckless capital management becomes obvious. The disciplined company may tighten spending or delay non-essential projects, but it doesn't have to restructure its balance sheet in a crisis. The overleveraged one may face forced asset sales, dividend cuts, or even bankruptcy. Balanced capital discipline also means thinking in terms of optionality. A company that enters a tightening cycle with a healthy balance sheet has the freedom to act strategically when opportunities arise. It can acquire distressed competitors, invest in capacity, or secure long-term supply contracts at favorable terms, all because it isn't constrained by crushing debt obligations. In contrast, companies that overextended themselves during the easy credit phase are too busy managing liabilities to take advantage of those same opportunities. The debt becomes a chain that locks them in place while more disciplined competitors move forward. There's also the matter of market perception. Investors and creditors watch leverage ratios closely, especially when the macro environment shifts. A company with a track record of prudent balance sheet management earns the benefit of the doubt. It can raise capital more easily, negotiate better terms, and maintain confidence in its long-term viability. That confidence feeds back into stability, creating a reinforcing loop where strong discipline attracts better financing options, which further supports stability. Ultimately, avoiding destructive leverage isn't just a defensive move, it's an offensive one. It's about ensuring the company is in control of its destiny rather than being at the mercy of debt markets. Balanced capital discipline allows management to set priorities based on strategic goals, not on the urgent demands of creditors. It turns the debt cycle from a threat into a landscape of opportunities where downturns are moments to strengthen, not merely survive. Over time, this mindset compounds just like a growing dividend. It builds a reputation, a resilient balance sheet, and the ability to navigate uncertainty with confidence. In a world where leverage amplifies both gains and losses, the companies that master this balance are the ones that endure, expand, and lead through every phase of the cycle. Let me leave you with this: in debt-ridden cycles, the path to strength is not through frenetic growth, but through steadfast consistency. Dividend-paying companies offer that consistency, not spin, not hype, but unwavering discipline and real earnings. Custodians of calm in chaos, they remind us that in the great cycles of debt and recovery, slow and steady doesn't just survive, it ultimately wins.